Hi everyone, welcome back to Investing Club. In this video we're going to talk about why banks will cause the next stock market crash. So right here we have the July 2020 Senior Loan Officer Opinion Survey on Bank Lending Practices. And this is something that comes out every month, and it gives an insight into the lending markets and talks about how freely credit is flowing through the economy. And in July, we can see that the conditions weren't that good. In July, banks tightened their standards on commercial and industrial loans, and they also reported weaker demand for these types of loans. In addition, banks tightened standards for all three major commercial real estate categories. Now, lending to businesses, more of the same thing. Banks have been tightening their credit standards for loans to businesses, and even for lending to individuals and households, banks tighten standards for residential real estate lending. Not only residential real estate, but also consumer lending. So for consumer loans, those loans are now a lot harder to get since banks are tightening their credit standards. And you may be asking, well, why is this a big problem? Obviously, banks are going to tighten their credit standards at a time like this where a lot of people aren't going to be able to afford a loan. Why wouldn't banks make sure they're only lending to the highest quality customers? And that is true. That is a big reason why the banks are doing it. But a consequence of these actions of tightening credit standards is that it has the potential to cause a huge slowdown in the economy. When you think about every recession that's happened, they usually have a certain cause attributed to them, like 2008 was real estate, and before that 2000 was the dot-com bubble. But the thing that all these recessions have in common is a tightening of credit from banks. Because how well the economy is doing depends on how freely credit is flowing throughout the economy. And so when times are good and credit is easy to get, that's when the economy thrives. But when credit starts to tighten up, that's when money stops moving around the economy, and that's when you really see a slowdown in the economy, and that usually causes a crash in the stock market. So now we can take a look at some of these graphs just to see how tight these credit loans are. These are number of banks tightening standards for commercial and industrial loans, and we are right up at almost the point that we were in 2008, right before that real estate crash. So right now, this is definitely not a good look for the economy. Where we saw the first stock market crash in March, that wasn't really due to credit tightening, that was due to a health crisis that we were facing. But now I think we have the potential for another wave of panic in the stock market as this credit tightening makes its way through the economy and really causes growth to slow down. And an interesting thing about this graph is that it matches up very well to what the interest rate is. So I can overlay a chart of interest rates on this chart of how tight credit standards are, and you can see it matches up very well. And this is because when credit standards are tight and the number of loans being made is shrinking, the Fed has to do something to stimulate the economy. And what they do usually is lower rates, and that gets more credit-worthy people drawn into the loan market now that they can borrow money at a lower rate. We can also take a look at demand for commercial and industrial loans, also down, because when the standards are so high now to get a loan, obviously there's going to be less interest. And while that isn't as low as in 2008 yet, it's getting there. The trend is definitely heading down, and that is something to watch. And it's the same thing for commercial real estate loans. The credit standards are now as tight as any period besides 2008, which is probably one of the worst periods ever for real estate. Again, commercial real estate loans demand all the way down to just about those 2008 levels definitely does not bode well for commercial real estate. And here's a chart for residential mortgage loans. And again, the common theme is these banks are tightening their credit standards for pretty much any type of loan, whether it's commercial or residential. We can also take a look at consumer loans. Again, tightening standards right about those 2008 levels. And here's an interesting one. Domestic respondents that have an increased willingness to make consumer installment loans, that's way down as well. Now here we're back at the top chart, and I showed you how it matches up with interest rates, where when credit standards tighten, that's when the Fed usually lowers rates. But we're at a huge problem right now, and that is the Fed can't really lower rates anymore. Here's a chart of the federal funds rate. We are literally at the lowest point ever in terms of what interest rates are. We're at just about 0.1%, and I think this has the potential to be very bad for the economy as credit standards are tightening, and now what is the Federal Reserve going to do to entice new borrowers into the market? There's not really much they can do when interest rates are already at the lowest they can be. And right now, I think that's my biggest case for why I think we'll see another fall in the stock market, is because we're seeing credit standards tighten, and that's likely to keep increasing, while the Fed back in March already lowered rates as much as they can, and that didn't really do anything to offset this credit tightening. We're still seeing it happen through July, and now there's really nothing else the Federal Reserve can do in terms of interest rates. They're already at the bottom. They're already at the lowest they can be, unless you think they can go negative, which I suppose they could, even though I'm not sure that's very likely. Now, I think longer term that has some implications for the stock market, but in the short term, here's why I think the stock market could actually keep going up. So this is the 30-year Treasury yield, and it's been going down, and I think there's still room for the 30-year to go down. We are still at around 1.2%. And so that has room to go lower. I think as credit standards continue to tighten, we could see this go down to under 1% and ultimately end up just around 0%. And so in the short term, this could actually be a good thing for the stock market, as investors don't want to invest in a 30-year bond anymore when it's really not paying anything. They'd rather just have their money in the stock market. A chart that I think is super important to look at, it is called the MOVE Index. And basically what this chart is it measures the volatility of bonds. It's like it says the Treasury VIX index. So this is basically the VIX of the bond market. And how this MOVE index works is it works the opposite as the normal VIX. So in the normal VIX for the stock market, when the VIX goes up, what happens to the stocks? The stock market goes down when fear increases. With bonds, it's actually the opposite. When the MOVE index or the Treasury VIX increases, it actually means bond prices go up. And what does that do to the yields when bond prices go up? Bond yields fall. And so if you take a look at where we are at this chart right now, we are literally at the lowest point on the whole chart, going all the way back to 2003. This is the lowest level we've ever been on this index. So when you put this chart together with banks tightening credit standards, with the Fed's commitment to drop rates all the way to 0, and now you see the MOVE index at one of its lowest points in the past 20 years, seeing this shows me that there's a good chance bond prices are going to move higher, and that will make the yields go lower. And when that happens, again, there's a good chance more money will move into the stock market, as people don't want to buy bonds if they're yielding basically 0%. Another thing to look at is the sentiment report. This is something I talked about on a video probably a month or two ago, and it really shows how the market usually does the opposite of what most people are expecting. When most traders are short the markets tend to go up, and when most traders are long the market tends to go down. And this chart that shows the stock market this year illustrates that well. And what we can see is most traders are still short the stock market. And I think as long as this continues, the stock market could continue to go up. So this is another thing I'm watching. As soon as we see a larger percentage of traders start to be long the market compared to short, that's when I think there's the potential for a pullback in the stock market. So I'll put a link to this website in the description. It's dailyfx.com, and it's the client sentiment report. And so definitely check this out every once in a while. I think it's an important thing to do, to take a look at what the mindset is of participants in the stock market. So that's it for this video. I think we saw the huge stock market crash in March due to the uncertainty about the pandemic, but now I think we're in trouble as we're starting to see credit tighten up to a point that we haven't seen since 2008. And I think unless something changes that will allow the banks to loosen their credit standards, it's not going to be a good thing for the economy and ultimately the stock market. So that's it for the video. If you found it helpful, hit the like button. If you want to see more videos just like this one, subscribe to the channel and hit the bell icon so you get notified every time I upload a new video. And I hope to see you on the next video.